Hey everyone, and welcome back to Safe Simple Sound Tax Edition. I'm your host, Sam. Today, we're diving into a topic that touches many of us but often brings up questions. Those special income situations that fall outside a standard W-2 paycheck. Filing taxes can feel complicated enough, but when you add in side hustles, unexpected windfalls, or other unique financial events, knowing how to report everything correctly becomes even more crucial. Our discussion today is grounded in the detailed guidance provided in Part 2 of IRS Publication 17. This official resource really lays out the rules for various non-standard income types. Think of it as the IRS's guide to everything beyond your regular salary. Now, looking through this information, a couple of things really stand out. First, the sheer variety of what the IRS considers taxable income is quite broad. Things like bartering, certain canceled debts, even found property can count. Second, the rules can change significantly based on timing, especially noticeable with the Alimony Tax Rules, which differ dramatically depending on when your agreement was finalized. And of course, the rise of the gig economy means self-employment income tax rules are relevant to more people than ever before. Here at Safe Simple Sound, we're all about helping you seize financial control and understand your financial choices. Knowing how to handle these special income situations accurately is a core part of that. It ensures you're meeting your obligations, avoiding potential penalties, and keeping your financial foundation truly safe and sound. Accurate taxable income reporting isn't just about compliance, it's about clarity and confidence in your financial picture. Our aim is to bring clarity to these often confusing areas, making the information accessible and helping you feel more prepared. We'll keep it focused on the facts and practical steps you need to know. So get comfortable, maybe grab something to take a few notes, and let's get ready to decode these special income situations together. All right, let's start with something that's become incredibly relevant for so many of us, navigating the world of self-employment income tax and gig economy taxes. You know, the way we work is changing. Maybe you've got a full-time job but drive for a rideshare company on weekends. Perhaps you sell amazing crafts on Etsy, do freelance writing, tutor students, or take on short-term contracts. These side hustles, or even full-time independent careers, are fantastic ways to build income, but they come with their own set of tax rules that can feel a bit daunting at first. So let's break it down and make it feel a lot more manageable. Shall we? First things first. What exactly is self-employed in the eyes of the IRS? It's broader than you might think. If you're working for yourself as a sole proprietor, an independent contractor, think freelance, graphic designer, or consultant, or even a member of a partnership, you likely fall into this category. And crucially, this applies even if it's just part-time work alongside a regular W-2 job. That weekend gig? That online shop you run? Those could absolutely count. Even some less obvious things, like maybe receiving income for specific tasks found online or directly from clients without being on their payroll, often put you in the self-employed bucket for tax purposes. Okay, so you've identified you might be self-employed. Point number 2, what counts as your gross income and how do you report it? Basically, all the money you earn from that self-employment activity is your gross income before expenses. This includes payments you receive directly, but also amounts reported on forms like the 1099 NEC, the 1099 MIC for other types of income, or the 1099-K, which reports payments processed through third-party networks like payment apps or online marketplaces if you meet certain thresholds. Think of it like gathering all your earnings in one place first. You'll typically report this income, along with your related business expenses, on Form 1040 Schedule C, Profit or Loss from Business. Now here's a really important piece, understanding self-employment tax. This often catches people by surprise. When you work for an employer, they withhold income tax, and they split the cost of Social Security and Medicare taxes with you. When you're self-employed, you're responsible for both halves, the employee's share and the employer's share. This combined amount is called self-employment tax, and it's in addition to your regular income tax. You'll calculate this using Schedule SE if your net earnings from self-employment are $400 or more. It's a critical part of taxable income reporting for the self-employed. Which brings us to point 4, why accurate reporting is so vital. It might be tempting to overlook small amounts of cash income or think, does this little side project really matter? Yes, it absolutely does. First, reporting all your self-employment income tax correctly ensures you're compliant with tax law, avoiding potential penalties and interest down the line. But perhaps even more importantly, for your future, the self-employment tax you pay directly contributes to your Social Security and Medicare coverage credits. Consistently reporting your self-employment earnings helps build your record for future retirement and disability benefits. Underreporting now could mean lower benefits later. So, how do you manage all this effectively? This leads us to our final key point: record-keeping essentials. Honestly, this is non-negotiable. Being meticulous about tracking both your income and your expenses is your best friend. For income, keep track of all payments, whether you get a 1099 form or not. For expenses, keep receipts and records for anything directly related to your self-employment activity. Supplies, software subscriptions, mileage logs if you drive for work, a portion of your home office costs if applicable. Good records not only ensure accurate taxable income reporting, but also help you identify all the legitimate deductions you're entitled to, which can lower both your income tax and your self-employment tax. Think about it. Proactive planning and good records throughout the year make tax time so much less stressful than trying to piece everything together frantically in April. This avoids common pitfalls like missing deductions or guessing at income figures. All right, let's quickly recap the key takeaways for handling self-employment income tax and gig economy taxes. 1. Understand if you qualify as self-employed. Even part-time work counts. 2. Track all your gross income, including amounts from various 1099 forms, and report it. 3. Be prepared to pay self-employment tax using Schedule SE if you meet the threshold. 4. Report accurately. It impacts future benefits and keeps you compliant. 5. Keep detailed records of both income and expenses. This is crucial. So, here's your call to action for this week. Take a few minutes to review your income sources from the past year. Did you do any freelance work, sell items online, drive for a service, or engage in any other gig economy activities? If yes, start organizing your income records and potential expense receipts now. Don't wait until tax season hits. Pull up the instructions for IRS Form 1040 Schedule C and Schedule SE online. Just browse them to get familiar. Getting organized early makes a world of difference. Now, we're going to shift gears slightly and talk about income you might receive due to specific life circumstances, alimony and unemployment benefits. These can sometimes feel a bit tricky when it comes to taxable income reporting, especially alimony, because the rules have changed significantly in recent years. So, let's break it down. First up, alimony. The absolute most critical thing to understand here is the alimony tax rules depend entirely on when your divorce or separation agreement was executed. Basically, when it was finalized. Here's the key distinction. If your agreement was executed on or before December 31st, 2018, think of that as the old rules. Then generally, the alimony payments you receive are considered taxable income to you, and the person paying the alimony can usually deduct those payments. It's a push-pull. However, for agreements executed after December 31st, 2018, so January 1st, 2019 or later, the game changed completely. Under these new rules, alimony received is not included in your income, and alimony is not deductible by the payer. It's just a transfer of funds with no federal income tax consequence for either party listed on the main forms. So that date is everything. Really dig out that paperwork if you need to confirm. Now, if you fall under those old rules, your agreement is from 2018 or earlier, and you received alimony, you need to report it. This goes on Form 1040 Schedule 1, specifically on line 2A. Make sure you have documentation showing the amount received. Remember, this corresponds to the payer potentially taking a deduction, so the IRS might be looking for consistency. Okay, what if you had an old agreement but modified it after 2018? Does that automatically switch you to the new rules? Not necessarily. The modification must specifically state that the new rules, the repeal of the alimony deduction, apply to that modified agreement. If it doesn't say that explicitly, you likely stick with the original pre-2019 tax treatment. So, read any modifications carefully. And just a quick, important note here. We're talking specifically about alimony. Child support payments are never considered taxable income to the recipient, and they are never deductible by the payer, regardless of the agreement date. That's a completely separate category. All right, moving on from alimony, let's talk about unemployment compensation. Many people experienced receiving unemployment benefits over the past few years, sometimes for the first time. It's crucial support during tough times, but you need to be aware of the tax implications. Here's the straightforward truth. Unemployment compensation is generally considered taxable income at the federal level. While there were some temporary exceptions during the height of the pandemic for specific tax years, the standard rule applies. You have to pay income tax on those benefits. This can sometimes catch people by surprise, leading to an unexpected tax bill if they haven't planned for it. So how do you report it? Your state unemployment agency should send you a form called Form 1099-G. This form shows the total amount of unemployment compensation they paid you during the year. You'll take that amount and report it again on Form 1040 Schedule 1, but this time on line 8Z. Keep that Form 1099-G with your tax records just like you would a W-2. Think back. Did you receive alimony last year? Do you know the exact execution date of your agreement? If you received unemployment, did you perhaps have taxes withheld, or did you set some money aside? Because these benefits are taxable, one strategy is to choose to have federal income tax withheld from your unemployment payments during the year, if your state offers that option. Alternatively, you might need to make quarterly estimated tax payments or adjust withholding from another job if you have one to cover the tax liability and avoid that surprise come tax time. So, wrapping up this section, key takeaway for alimony. The execution date of your agreement dictates whether it's taxable, deductible. Key takeaway for unemployment. It's generally taxable income, reported using Form 1099-G on Schedule 1. Here's your action step. If you received or paid alimony, verify the execution date of your agreement to determine the correct tax treatment. Get that date. If you received unemployment benefits, make sure you have your Form 1099-G and report the amount accurately on Schedule 1, line 8Z. For more detailed rules on alimony and divorce-related tax issues, refer to IRS Publication 504, titled or Separated Individuals. Okay, we've covered self-employment, alimony, and unemployment. But the world of special income situations doesn't stop there. When we come back, we'll dive into the sometimes exciting, sometimes confusing territory of gambling winnings, what happens when debt gets canceled, and a few other miscellaneous income streams you might encounter. Stay tuned to Safe Simple Sound. Next, we're diving even deeper into those special income situations that might pop up unexpectedly. We're talking about tax implications of gambling, windfalls, and other miscellaneous income. You know, the kind of money that doesn't come from a regular paycheck, but still needs the IRS's attention. So, let's start with something that gets a lot of people excited and sometimes confused: gambling winnings. Maybe you won big at the casino, hit the jackpot on a lottery ticket, crushed your fantasy football league, or even won a raffle prize. Here's the first key takeaway. Gambling winnings are fully taxable income. Yes, all of it. The IRS considers it income, plain and simple, and you need to report it. You'll typically do this on Schedule 1, specifically line 8B. Doesn't matter if it was $50 from an office pool or thousands from Vegas, it counts. Now, if your winnings are significant, say over a certain threshold, depending on the type of gambling, the payer, like the casino or lottery commission, might issue you a Form W-2G, certain gambling winnings. Think of this like a W-2 for your lucky streak. It shows the amount you won and, importantly, any federal income tax they might have already withheld. That's good news, because while you have to report the full winnings as income, you get to claim credit for any tax already withheld. You'll report the winnings amount from the W-2G on that same Schedule 1 line 8B, and then you claim the withheld tax amount down on the main Form 1040 line 25C, reducing your overall tax bill. So definitely don't toss that Form W-2G. Okay, so you report the wins, but what about the losses? We all know gambling doesn't always go our way. The rule here is specific. If you itemize your deductions, meaning you don't take the standard deduction and instead file Schedule A with your Form 1040, you can deduct your gambling losses. But, and this is a big but, you can only deduct losses up to the amount of your reported gambling winnings. You can't deduct more losses than you won. So, if you won $1,000 but lost $1,500 throughout the year, you can only deduct $1,000 of those losses on Schedule A, bringing your taxable gambling income down to zero. You don't get to claim a $500 loss against your other income. This directly leads to a crucial point addressing one of the questions we often get: what records should a casual gambler keep? If you want any hope of deducting those losses, you need proof. Think diaries, logs, receipts, tickets. You should be tracking the date, the type of gambling, the location, and the amounts you won and lost. Without solid records, substantiating those losses if the IRS asks becomes really difficult. So even for casual fun, a little record keeping can be a good habit, especially if you have some wins to report. Now, let's shift gears to another area that surprises people: canceled debts. Sometimes a lender might agree to forgive or cancel a debt you owe. Maybe a credit card company settles for less than the full amount. While that feels like a relief, the IRS often views that forgiven amount as taxable income. Why? Because you received an economic benefit. You didn't have to pay back money you previously received or owed. You'll likely receive a Form 1099-C, cancellation of debt, from the lender showing the amount considered income. Now, there are exceptions. The reference publication mentions certain student loans, and that's a big one often tied to specific forgiveness programs. Other common situations where canceled debt might not be taxable income can include debts discharged in bankruptcy, or if you were insolvent, meaning your liabilities exceeded your assets immediately before the debt was canceled. These exceptions have specific rules, so receiving a 1099-C doesn't automatically mean you owe tax on it, but it definitely means you need to investigate whether an exception applies. If no exception fits, that canceled amount generally gets reported as other income. Finally, let's touch on a basket of miscellaneous income streams. These are the odds and ends that don't fit neatly elsewhere but are often still taxable. Think about bartering. If you trade services with someone, say you design a website for a plumber who fixes your sink, the fair market value of the service you received is generally taxable income. Prizes and awards, won that fancy TV in the company raffle? Generally taxable at its fair market value. Yep, that counts as income too. Found property. If you find cash or valuables and get to keep them, that's considered taxable income in the year you gain possession, like finding treasure. Rewards. Received cash for providing information? That's income. These types of income often get reported on Schedule 1 under the other income lines. A guiding question we consider is, which of these are most likely overlooked? I'd guess bartering is a big one, as no cash changes hands. Small prizes or awards might also slip people's minds. And maybe even found property. People might not even realize it's technically reportable income. It pays to think back over your year. Did you receive value in any unusual ways? So let's wrap this segment up. The key takeaways are: 1. Virtually all gambling winnings are taxable income and reported on Form 1040 Schedule 1. Keep an eye out for Form W2G. 2. You can deduct gambling losses if you itemize, but only up to the amount of your winnings. Good records are essential here. 3. Canceled debt is often considered taxable income, though important exceptions exist. 4. Don't forget about various miscellaneous income tax sources like bartering, prizes, jury duty pay, found property, and rewards. These usually land on Schedule 1 as well. Here's your action item. Keep detailed records of all gambling activity: dates, amounts won and lost, where you played. If you received a Form W2G for winnings or a Form 1099-C for canceled debt, take the time to understand what they mean for your tax return. When you're preparing your taxes, carefully review the other income lines on Schedule 1. Did you receive any unusual payments or benefits this year? If you're unsure about any of these situations, consult IRS Publication 17, which has a wealth of detail. And that brings us to the end of our deep dive into handling those special income situations for your federal taxes. We covered a lot of ground today, drawing heavily from the guidance in IRS Publication 17. I think two really impactful takeaways are: first, the importance of meticulous record keeping, whether it's for your side hustle expenses or tracking gambling activity. And second, realizing how broad the definition of income can be, making awareness key. Understanding these nuances is crucial for accurate taxable income reporting. Remember, knowing how to handle these different income streams correctly is a vital part of seizing financial control and understanding your financial choices. The core mission here at Safe Simple Sound. It helps keep your financial life compliant, clear, and truly sound. Thank you so much for tuning in today and investing this time in your financial knowledge. I truly appreciate you being part of the Safe Simple Sound community. For links to resources including IRS Publication 17 and a recap of today's key points, please check out our show notes. If you found this episode helpful, consider leaving us a review or sharing it with someone who might be wrestling with these very income types. And of course, hit that subscribe button so you don't miss our future discussions designed to simplify the complex world of personal finance. We'll be back soon with another episode aimed at helping you build a stronger, more secure financial future. Until then, stay informed, stay empowered, and keep making those sound financial choices. This is Sam, signing off.